British American Tobacco announced it would cut 9,000 jobs, 1 in 5 of its entire global workforce, and the stock fell barely 1.6% on the day before recovering. That recovery deserves more scrutiny than the cut itself. The maker of Lucky Strike cigarettes and Vuse vapes had been up 11.8% year-to-date before the announcement, and the market's reluctance to sell harder signals a specific belief that eliminating 5,500 roles outright and outsourcing 3,500 more to Accenture is the right strategic move, not a distress signal. The bottleneck behind that belief is the cost structure. BAT is spending across a workforce built for a cigarette business that is structurally shrinking, and the £600 million annual savings target for 2028 is the number that investors are pricing in as margin recovery. But there is a gap between pricing in the savings and pricing in the growth. The cuts remove the drag. They do not by themselves close the revenue hole that falling combustible volumes are opening. That gap is what CH2 must answer. The Fit to Win program is not a new idea. It was launched last year, and the partnership with Accenture for AI-enabled back-office functions was already running. Jobs in the UK, Poland, Romania, Costa Rica, Mexico, Singapore, and Malaysia had already transferred to Accenture before this announcement. The 9,000 figure is the largest single-tranche disclosure in that journey, which is why the market focused on it. But the direction was not new. What is new is the scale. 5,500 direct redundancies, completed by the end of 2026, represents a pace of restructuring the company has not attempted before. The question the holder must answer is whether the pace of cutting is ahead of the pace of the replacement business, or chasing behind it.
The structural case for BAT rests on one arithmetic. New category revenue growth must exceed the rate at which combustibles revenue falls. BAT's own forecast is mid-teen percentage growth in its new categories for 2026, led by Vuse vapes and Velo nicotine pouches. That forecast was reiterated earlier in June. Dan Coatsworth, head of markets at AJ Bell, drew the opposing conclusion from the same trajectory. The tobacco industry has found the transition from cigarettes to next-generation products to be a slow one. Vaping is now commonplace, yet product manufacturers are battling challenging market conditions caused by a proliferation of illegal products. Two analysts, same set of facts, opposite reads on whether the transition rate is adequate. This is not an abstract dispute. BAT itself admits that U.S. regulators have taken a tough stance on approving licenses for new vaping products, and that this has fueled an influx of illegal Chinese competitors, weighing on market share in its largest single market. Reynolds American, the U.S. subsidiary excluded from the job cuts, is also facing consumers switching to cheaper brands under cost of living pressure. The tension reset comes from the global cigarette volume forecast BAT has itself published, a 2.5% annual industry volume decline in 2026. At 47,000 employees before the cuts, the cost structure was built for a business scaling up, not sideways. The £600 million savings by 2028 addresses the overhead problem. It does not address the top-line problem. What the bull thesis requires is that mid-teen new category growth is not merely matching the 2.5% combustibles volume decline, but substantially outrunning it in revenue terms, given that new categories still carry lower average revenue per unit than premium cigarettes in most markets. The pool does not provide the specific margin bridge between categories. That absent number is the fulcrum the investor actually needs, and it does not arrive until the half-year 2026 results.
There is a buried assumption in the £600 million savings target that the market has absorbed without challenge. The savings are incremental on top of whatever revenue base exists by 2028. The target was set assuming a stable enough revenue trajectory that the operating cost reduction translates directly into margin improvement. But if combustibles volumes decline faster than management's 2.5% forecast, which regulators' accelerating vaping license restrictions could cause, the savings will offset a larger revenue headwind, not generate free improvement. The Irish News reported shares down 1.6% at 4,674p on the announcement day. The FT noted the stock was still up 11.8% year-to-date. That divergence, up on the year, down on the day, represents the market running two theses simultaneously, a structural recovery thesis and a near-term concern. A holder and a watcher are watching different things. For the holder, the near-term monitoring variable is not the 2028 savings outcome. It is the H1 2026 new categories revenue figure, which will arrive in the half-year results and will be the first clean read on whether mid-teen growth is holding against U.S. headwinds and illegal product competition. A number below mid-teen in new categories, combined with combustibles volume decline steeper than 2.5%, would mean the cost cuts are repairing a larger hole than the market priced in the day it shrugged off the 1.6% drop. That is the condition that turns the restructuring narrative into a distress signal. Conversely, new category growth at or above mid-teen with combustibles declines close to the 2.5% forecast confirms the arithmetic. The savings land as margin, the transformation is tracking, and the 11.8% YTD run extends rather than reverses. The single metric to watch before acting is the new category's revenue growth rate in the half-year results. Confirmation above mid-teen makes the cuts a setup, deterioration below it makes the current valuation a trap. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.